Hi everyone, we're the investment team from Cal Poly San Luis Obispo. My name is Ben Akimi. I'm a third-year business finance major.
My name is Emil Georgiev. I'm also a third-year business finance major.
My name is Emily. I'm a fourth-year finance major at Cal Poly.
My name is Nate Andre. I'm a quantitative analysis student here at Cal Poly.
My name is Chance Moat, and I'm a fourth-year statistics major here at Cal Poly.
So as part of our investment philosophy, we wanted to focus on a simple strategy. Specifically, we chose to bet against beta. What that means is we want to go long on stocks that have low values of beta, and we want to short stocks with large values of beta. As part of this, we also wanted to integrate some automation in terms of computing these monthly beta values for each stock. So how we did that specifically is we wrote some software that would web scrape to get the risk-free rate from the Treasury website. Specifically, we use 1-month T-bills, and then we use API calls to get market and stock returns. And for the market returns, we use the Russell 2000, and then we use automated regression analysis to compute the betas for each stock.
So for our risk and return expectations, our initial beta goal was just to keep it at the lowest possible. Our current beta is actually at negative 1.09, and then our current returns is at negative 1.07, and we'll elaborate more on why that is. Our goal initially was actually 5%, and that's an annualized rate.
So at the end of 2018, we had a pretty bad bear market. The S&P 500 and the Dow Jones were down around 9%, while our portfolio was up about 15%. This is due to when we first initially invested, we had a beta of around negative 1.03, and then at the lowest it was around negative 1.31. As you can see, we pretty closely followed the inverse of how the S&P 500 was doing all through December. And then as the market started to go back into a bullish market, that's when our portfolio fell. And so for the future, what we're trying to do is we're trying to more closely match the current market beta rather than just trying to stay strong to our negative beta portfolio.
When the investment challenge initially started, we made most of our trades in that first week to try to maintain that low beta we were talking about. We did this to take advantage of the bear market we were currently in. Since then, we've been a little less active in our trading and mostly just made small adjustments to our portfolio to maintain compliance with the challenge rules. And in the future, we look to be a little bit more active in our trading, and if this bull market continues, we want to raise our beta to help increase our overall returns. And if it turns back into a bear market, we want to drop our beta again.
In terms of portfolio attribution, we use the S&P 500 as our benchmark, and we actually outperformed the S&P up until late December. Once the market turned around after December, our strategy hurt us due to our selection of low beta stocks. We also had a lack of adjustments, which hurt us too. In terms of what's next for us, we want to raise our portfolio beta in order to better match the market beta. And we want to continue maintaining compliance in the future. Thank you guys for listening.